Hello, Warriors. How's everyone doing? Alexander, Brock, Hugo, everyone doing all right? I hope so. So, let me get my charts up here. Everything's okay? Okay. Everyone see the ruble?
Yes, sir. Good morning.
Good morning, Stel. How are you?
I'm very well, bro.
Good. Is K-Man the man who would take a trade that no one else would at the desk around? Is K-Man here?
He's not here yet. I don't see him.
All right. Okay.
Morning,
So
guys.
you're pretty good.
We
at
have the next best thing, Ryan. No, carry on. What were you going to say?
No, you know about it. Who is buying rubles if the central bank of Russia is on ice? I mean, I showed this yesterday morning, a nice little 3 drive, and it came off. So far, a failing rally, and I'm interested. Who could be buying rubles?
Well, the question is, why would anybody be buying rubles? The thing is, if you buy rubles to say, you sell dollars, you buy rubles, you have a 20% carry. So if you close your eyes, you buy rubles now, you close your eyes, you don't care where it goes in the short term, where it goes in the next month or two. Eventually you're going to be in the money, and maybe you're going to have collected some nice carry as well. But it's not the way to do it, I don't think.
I think you need to look at the context as well. There's no one that I know, probably no one who can trade I'm going to call it the rubble for the future, as a retail broker, because all the retail brokers have either switched it off or margined it to oblivion.
So you can't trade it if you want to. Yeah.
Kevin's saying the U.S. because they're still buying Russian oil. But why?
That's the thing. Not the whole of Russia, not every single business or every single entity in Russia has been sanctioned. So there is still commerce going on. The problem is what you're seeing on your screens, what we all see on our screens, are not indicative of the actual trading price. The only way you'll get a price to actually transact any business is to phone up a bank who's still doing ruble and ask for a quote. And it's going to be, a million miles wider than what you're going to see on the screens there. So, we can't even take these prices on the screens as a reality of what the actual market is.
Okay. I appreciate that because, it was a mystery to me. Yeah. I couldn't sleep last night because
the problem is that when you have a market which is in distress like this, I still remember 2008, the crisis when every spread was blowing out. You would ask for you will have a screen that shows a mid price for a certain spread, and you would ask a broker. I would ask a broker, where do you deal that? And he would be like, 50 bid, no offer. So, it's very difficult to actually get a price. And if you do get a price, it's not going to be anywhere near where you think middle is.
Yeah.
Okay.
And you've made some prices in your time still, so you know exactly.
Yeah.
All right. Good to have experts.
Yeah, and then obviously if you're a market maker in these times, like we were back in 2008, and you get asked by big clients like hedge funds, you got to make me a price. You have to make a two-way price, and you can't make it too wide either. So it was like just a suicide mission every time you made a price, because you knew if you trade with them, your trade's at the wrong level. If you don't trade, you dodged it, but if you trade, you're screwed.
Yeah, and then you're getting on the phone to someone else to try and hedge it off.
Exactly. Yeah.
Okay, so Euro, still feeling it because it's on the same continent, but we've been down to this line a couple times, and actually I had a 78.6 at 109.98 from this whole move. Well, I have to go to a weekly. So,
you got to start moving out the time frames, haven't you, Dale? We get to the big levels.
One ugly week. Yeah. So what you were talking about yesterday, Ryan, about the option setup, they have plenty of time. When do those expire?
What I looked at was over the next 3 months, so all the daily expire 3 months. So it's quite a long period, but they're all going to be sitting at 110. That 110.
Okay, well that looks pretty ugly. We've had a couple intraday bounces, but maybe we're going to just eat right through this long-term trend line.
It's looking,
I can't buy the euro until I see I was looking for about 98.5, 98.20. Looks like Blake has an alert, or someone has an alert here. Okay, so that's Amanda. She'll be taking profits there. Interesting. That's why you guys have to get in the room. You know, I see Amanda's trades flash up here on TradingView, and they're outstanding.
Have a look at Euro Sterling.
I know, you were right. New low.
There. Finally the 83 break.
Jim Carroll, welcome. Welcome to F.A.C.E. Looking forward to talking to you. Yeah, so where are you going to start thinking about stepping in? 82? Still. Go ahead.
Still there?
Ryan?
Yeah, I was going to say we're still bang on that 2019-2020 double bottom. So we're finding resistance at 83 now, which is a good signal. We've broken it and it's resisting, but now we need to crack that double bottom. And funny enough, I'm actually long on a scalp at this area. I'm still short. I took a bit off my long-term short at 80 this morning, just because I missed it on the BOE move. But I've actually got a scalp long here because it is a big level. So if it does bounce, I'll hopefully steal a few pips. But I'm going to reverse that into a short if it breaks 70.
Okay. So you see how Ryan has every base covered based upon market action. Now he's going to hold or reverse. And reversing isn't easy for most people. In fact, you know, something that someone told me once, because I always take profits too soon. They said, well, Dale, why don't you look at the chart? And unless you're ready to reverse, walk away.
Yeah.
So
you've got to be able to trade both ways. You can't marry a bias or a direction.
Yeah. But reversing's tough for some people, especially if the first part of the trade was not successful. Yeah, reverse after a loss, you really have to be a pro to do that.
What did you say, Ryan? You have to go both ways. You can't marry. What kind of a webinar is this?
But more importantly,
flexible in the markets only.
Yeah. More importantly, for people who have been checking out the Traders Funding Program, you know, you can go both ways on a trade. I know some of the US clients, you know, they have the FIFO rules. They can't trade against positions or even chop positions about. You can if you're in the Traders Funding Program, because you can do that via the broker.
I got to say this, and I'm glad you mentioned it. And good morning, guys. As a US trader, it is a huge benefit when you can actually parse out positions and trade a position. Like if you buy the euro 3 different times at 3 different prices, and you're like, well, I want to keep the one that I've got the most profit in because I've been sitting in it for a week, and then you're just cutting off little slices that you're trading along the way. Oh, it's like a godsend. It's crazy.
It's probably one of the biggest features of the program, you know, without giving it too much of a sales pitch.
And being a US trader, you trade CFDs on cryptos. I mean, you know, like if you live in the US and you want to trade short a crypto, you are going to have to, you know, cough up money for a margin account, you know, and that's the only way I can trade. Well, I guess I could buy Bitcoin futures and short futures, I guess, too, but that still requires more money in your account. So yeah, trading a CFD with like little amounts of money and being able to trade both directions and 1,000 different products. That's it literally is almost 1,000 products. It's pretty cool. Anyway, sorry, I had to jump in and mention that. I'm going to be quiet. I want to hear you guys what you have to say.
You get to be a European, no matter where you're domiciled. That's really, you know, you didn't have to move.
Yeah.
Yeah, you didn't have to just change countries.
Christopher's just asked a question about the program in the chat there. Christopher, if you want to take that if you're in the chat room, the main chat room, take that to the discussion. We've got a Traders Funding Program discussion in there. Take that in there and you'll probably get your question answered easier there.
Okay. I guess the other feature was how yield snapped back after Powell. You know, they're not making new highs and they're down a little bit today, but that was a pretty good recovery. Still lower high. What do you think? We're going to blast above these highs into the Fed? or is this good? This looks like it could have a look of a head and shoulders. If we develop some type of right shoulder here, under 170, there's space underneath it.
I think the bounce there is the bounce there is because Powell, he hasn't taken all the path off the table. They're still going ahead as they see fit. Yeah, there's obviously Ukraine worries to come in and uncertainty, but as far as they're concerned, they're ready to go.
Yeah, moderately. He took the half off the table.
Yeah. Well, then he put it back on again.
Hello, everybody. He actually did not take them completely off the table. He first went like, "Oh yeah, we'll go for 25," and then literally 1 minute later, he came like, "Oh, but we could still do 50 if nothing else changes on later meetings." Okay. So he's speaking split tongue for the time being.
Yeah, so
I think it's range 170 to 2% until the meeting, and then we'll see, right?
Yeah. I guess you react to the meeting, and of course, oil keeps marching.
And of course, none of that matters either, because with inflation shooting higher from 7.5%, 0.25%, 0.5% rates, none of them is going to make a difference.
No, it's pretty indifferent right now. We've seen it on okay, the only difference it can make a little bit is to have the different central banks versus each other. Like for instance, Canadian is a bit stronger versus euro, like the rest.
Yes, and also just the display of intentions. That's the only difference it can make.
Guys, you're talking about inflation. Did you see today's Eurozone Producer Price Index release? 30.6% year on year. And I take a wild guess who's going to pay that. It's going to be the consumer. So if people think inflation is going away anytime soon, man, you have to think again.
And
why would inflation go away with monetary policy and fiscal policy still being on extraordinary loose levels? I mean, why would it go away?
It'd be magic, Steve.
Yeah,
magic
that's the only way, actually.
Do you guys think if the dollar turns and this ends up being a big bear market rally on, say, like the weekly, and I know that, we're approaching 61.8 back of, from here. If
I think
the dollar's the last thing to turn bad, I mean, the metals have turned good, oil's happening, commodities are happening. Do you think the Fed would welcome a weaker dollar?
Weaker?
Yeah, if this is just a bear market rally and it peaks in here.
Dale, the U.S. trade deficits keep pushing all-time record highs every month, and that obviously means the following. Since the U.S. consumer is based not exclusively, but at a huge extent from imports, guess what a weakening dollar is going to do to inflation?
Yeah, that's what I was saying. It's going to fuel it.
It's going to fuel it even further. Yes.
Yeah. So it's gasoline on the fire.
Yes. That's exactly what it will be.
The problem is that the world can't handle a very strong dollar, at least not for very long. So you're going to have emerging markets, economies under severe stress. So it's a balancing act.
I was thinking about that. While I was.
I think that'll happen with QT also, right? If they start there. Then you can see the dollar fly a bit, in my opinion.
So,
for the short period of time that's going to last.
This is Brazil.
We'll see.
Would you consider, the strong dollar certainly is not hurting Brazil because, they're a big commodity producer, but that's a great looking chart. And it really just started at the beginning of the year when we were under pressure, started to become under pressure. Can anyone explain it? The only thing I could come up with is that they're a big commodity producer, grains, livestock, a lot of beans, and oil. So,
exactly.
What do you think?
You said it.
Yeah, you said it, actually.
Okay. All right. Well, I'll come up with a question without answering it myself. All right.
That sounds like a good idea.
What about S&Ps? You know, I'm looking at this formation in the S&Ps. It looks like a bit of a falling wedge here. And, you know, you have to respect how well it's, I was saying that, you know, here the DSI was 10. Okay, so we're approaching this wedge line. This to me looks to be the kind of the line in the sand, 4,500 or so. What do you think? We're going to get a third drive here? Ryan thinks so. It may be delayed, but he's looking for this. What do you guys think? I know sell rips. Would you sell a rip at this, you know, confluence of a moving average?
Yeah, the 50 and the 200. Yeah, that would be a really nice spot, I think. But,
yeah,
you know, for me, we're still caught in a place where geopolitical environment is not good for risk. I mean, that's a given. And yet we're still higher than where we were before the Ukraine invasion. And if that gets resolved, or, you know, even if that doesn't get resolved, we have the FOMC in nearly 2 weeks or just under 2 weeks, and they're expected to continue with the path that they've told us. Now, obviously, if they change tack, then that changes everything. You know, if they become dovish, then that changes everything. But until then, I don't see why selling rallies shouldn't be the way forward. But the problem is you have to pick your spots.
Yeah.
Yes.
Because right now, there's very likely a rotation out of European stocks into US and the far from my bed stocks like and in currencies as well, like Aussie and Kiwi, and once the rotation is over, then we might see a catch up of the US stocks catching up on the European if the conflict is lasting longer than expected.
Yeah, there is also the problem with the possibility of swings and timing that is going to be very, very tricky, because I think there is a likelihood that if we get a de-escalation of the Ukrainian situation, we might see a short-lived rally higher, in which case, of course, you don't want to be short. But I think it's going to be short-lived in the sense that, as Stelios said, and as we've said before, the market will have to focus its attention again after celebrating for, I don't know if it's going to be a few hours or a few days. It might as well be a few days. Then the market will have to refocus again on what matters on the front of monetary policy and the big shift we're seeing in it. So once people respond with buying, they will immediately start thinking again like, yeah, okay, now I'm buying because the Ukrainian situation is somewhat resolved. But wait a second, I mean, central banks are still going to be, cutting off the monetary heroin. And, you know, they're talking about quantitative tightening. They're talking about many rate hikes. I mean, that's probably not good for the markets.
Yeah, the wake up could be a bit hard once.
So we're on the verge of a trend break in Aussie here too. Check it out.
Where's your trend line, Dale? We've had this all morning in the room.
You know, it's not even mine.
It's actually mine. You know why, Dale? Because you're using my link when I connected you.
I was trying to figure out why I was trading so lousy. Okay.
Now you know.
You know how technical I am. So
now you know.
Anyway, I thought it was Blake's, and gosh,
no, that's mine.
Go back. All right. Well, anyway, nice line. So since it's your line, you anticipating an upside breakout here, Steve?
You know what I'm going to tell you? We're currently on resistance. Would you be buying resistance?
No.
Yeah, but if we break higher from that, I think that's a pretty decent bullish signal, right?
Yeah. Okay, let's see what else Steve is.
By the way, Palladium just keeps going. It's an absolute monster. Platinum as well, but Palladium is the one.
Yep.
And uranium. We had Dave on, and this is something I think it was Shy Girl who told me about this stock that she was in. This is it. It's,
uranium, in my opinion, is a very, very good bet at the moment. First of all,
it looks like new highs.
Technically speaking, it had a very, very impulsive move higher. Then it had a corrective move lower. And perhaps it has already resumed its uptrend. But what I like about it is that there is also a very nice fundamental justification behind it, right? Yeah. What's happening at the moment is going to further increase the cost of fossil fuels, which means that it will have to force governments to rethink their stupid policy, because in my opinion it was purely reactionary following the Fukushima accident.
Right.
We had a lot of people that were seeing these pictures, and they were immediately like, oh my God, look what can happen if you have a nuclear reactor. We need to denuclearize immediately, blah, 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 blah. And, governments wanting to satisfy people made the big mistake of rushing into denuclearization without having a plan B, in essence, to replace all that electrical supply that fast. So now with crude oil being where it is, and the rest of the traditional fuel sources, of course, more or less following suit, they will have to certainly rethink about nuclear energy production plants.
Yeah, you have countries like Germany who are switching off all 6 of their reactors, and it's funny because you have the Greens saying, "Oh, this is terrible, nuclear power and all that," and everybody's saying, "Yes, we agree." And then when oil prices go to 115 and it starts actually hurting your wallet and your pocket, then you're going to say, "Oh."
I was having a conversation with a German friend of mine a few days ago, Stelios, 3-4 days ago, and he was telling me how ridiculous this policy is. He was telling me the example that, because he's into that stuff, he said that Sweden also did the same thing, but they couldn't replace the energy consumption. So what they did is they outsourced that to Denmark, which had literally a nuclear plant 30 kilometers from their border. So they closed their nuclear plant. But they have no problem importing the energy from a nuclear plant that's 30 kilometers away. Like if an accident happens there, radiation is going to be like, wait a second, where's the border to Sweden? Because I can't cross that over.
Same with Germany, right? They're shutting down theirs, but France has a load of them, and other European countries which are next door.
And France is supplying Germany now with.
It's so. Anyway,
it's a charade. It's politics. It's simply politics. What do you want, guys? Oh, you don't want nuclear energy. Okay. Well, don't worry. We're going to shut our nuclear plants down. It doesn't matter that we're going to be importing energy from nuclear plants that are, stupidly close for radiation from other countries. On our side, we did our part, right? We closed our nuclear plants.
Yeah,
so you can't blame us for an accident. Yeah.
Anyway,
yeah. So
we've put the world to rights today, haven't we?
Yeah.
So Dixie, technically, maybe we're not going to confirm. I mean, this was confirmed.
Dale, you've almost taken the control of the charts the whole time. I better take over the charts over here.
Thank you, Blake.
We don't need you.
Cow.
I was going to say,
Blake.
When you let Steve just talk, he just starts telling stories about who knows what he's talking about. So I was just letting him go a little bit.
Needed to ventilate, buddy.
I mean, I figured today was, a day where things are kind of quiet, so might as well let him go off the handle a little bit. So, I think we all should be watching the stock market. I mean, I know K-Man or Ryan were talking about just a little bit earlier. I had to step away from my computer about European equities, kind of out of European equities and the US equities. All this could be flow driven, as you're pointing out. And but you look at the S&P. I mean, we're closing in on the 618 retracement. We got a little wedge. Some people are looking at it as an inverted head and shoulder pattern. Doesn't matter. Regardless, it's a bullish pattern. It's a bullish setup. But I was looking at the Russell 2000 yesterday with Chris Weston on the trade-off last night. We were looking at a double bottom setting up, and I mean, this is the breakdown point. You have to realize that we had the year-long range breakout to the upside, false breakout, then break down. Now we have a double bottom. There's, if you think about why stocks could go up here, there's a multitude of reasons why they could. Do I think that, the S&P is going to all-time highs? I personally don't think so. But you have people like Jim Welsh from Macro Tides, Dale, who he thinks that, we hit a new low around 4K and the S&P, and we're heading to new highs next. So there are those people out there, but look, interest rate expectations have come down dramatically over the course of the last couple of weeks because of the Ukrainian situation. And, all we need is some sort of ceasefire, de-escalation, and I think the markets could really pop. Are we going to go to new highs? I don't think so, but there's a good chance that we could continue to squeeze higher. And that is a possibility at this point. So I think you should keep an eye on some of these markets. I think they are looking constructive. One thing that's not looking constructive is the euro. The euro is depressingly heavy. I have some euro crosses on, and they have eaten into my last month's profits into February. What's happened over the course of the last couple of days. So, and they're not huge positions, but it's a case where you have small positions can really eat away at your P&L if you let them go. And like you look at some of these euro, just look at the euro across the board. You've got the euro dollar that's obviously trading below 111. You got the euro sterling at major support, which you guys have talked about. This is really key on a weekly basis. So everybody's watching the euro sterling. The euro Aussie has absolutely come unglued. Euro New Zealand has come unglued. Euro Canadian, which I happen to be long some, has just come. That's just come unglued too. So, just you have to keep in mind that in this environment, you got to keep. Hold on, Chinese. Sorry, I'm just looking. There's a nice spike up in futures right now, so I'm not sure why. No particular reason, but also look at the move in crude right now. Crude is actually rolling over. This is one of the things that I really want to see happen. Is I want to see crude oil actually start to make a move lower. Now it is really bullish. And I think while it's above 105, you got to be careful being on the short side. But man, we are pretty overbought at this point. So it's it'd be interesting.
TSI is 94, I think, Blake.
What's that?
TSI, I think, is 94 from yesterday.
Yeah, well, I can't remember if it was 92 or 94, but I know gasoline was at 94. Yeah, they are very, very sentiment is way over, is way
well, because no one could think of one reason why oil would go down. Can you?
No. Yeah. That's a great comment, Dale. Do you guys have any reasons why crude oil should go down right now? Any reasons?
No.
Anybody?
Yeah.
I'm asking the team here.
OPEC will cheat and Putin will raise production. I saw that yesterday, that Russian production is up. And if neither of them...
people are not buying Russian oil. That's the problem at the moment. Yeah.
But it's fungible. The supply isn't off the market. People are. China?
We should buy NFTs of oil.
Yeah, if that was the case, the other day it was being sold at a record discount, and still there were no bids for Russian oil due to countries doing it on purpose, of course, right? They're boycotting, and you're right. Eventually, Russia is going to find a way, since it's fungible, as you said, Dale, to perhaps send it to China or whatever. But Chinese are not stupid, right? If you know that somebody's in distress.
Well, it depends what Chinese you're talking about. You talk about me. I'm not the smartest. I'm not the brightest bulb in the.
You're only half.
That's because you're half Chinese.
I'm only half. That's right. Continue on. Sorry, bad joke.
Walked into that
one. So Chinese are not stupid. They can definitely get, for example, Russian oil at a very, very decent discount. Yeah, they will do them the favor of buying it, oppositely from other people that are not buying it at all. But they're going to buy it at a discount, right?
India as well.
Chinese, don't interrupt an enemy when they're destroying themselves.
Yep, that is actually
very true, right?
Very true in this case. Very true.
Hey, really quick, I know we're going to be running into Steve's. Sorry,
Steve's. Well, Steve did it yesterday.
Dale's interview. The thing I wanted to point out is that obviously, I think today's probably good as day as any. As we talk about it with the ForexAnalytix clients, but I just want to make sure I'm saying it here too. Guys, keep your position small, stops wide, position small, because it's dangerous out there. I mean, these moves are really, really brutal. I was on
especially something like oil.
Oh yeah, well, so I was very preachy last night on the trade off. That was the Pepperstone show that I do with Chris Weston once a week.
We're all in your church, Blake.
Yeah, but we were talking about trading, and I'm like, okay, well, my positions are a quarter size of what I normally trade. I mean, they just are. Smart. So if you think about what you're doing, like if you normally trade 10, I'm trading like 2 or 3, right? So like lots or whatever, thousands, whatever it is you're trading. I'm trading about a quarter size than I normally trade. That's because you have to widen your stops to let things, so you don't get stopped out. You can let the volatility play out a little bit and hopefully catch a trend going in whatever direction you want it to go. So I'm trading smaller positions, wider stops. But I was talking about crude oil yesterday, and one of the viewers said, Blake, I disagree with you. Trading small positions, tight stops, you should be doing it. And I'm like, no, you misunderstood me. I'm very much in the camp of trading small positions, wide stops right now. And I'm not scalping with big size, which I do during low volatility period times. But I was specifically talking about crude oil because Chris asked, well, Blake, what would you do here? And I'm like, nothing with crude. I mean, if I did short crude, like if I was, because I started talking about the typical trader tends to try to find strength and they want to fade strength. That's trader DNA. Your DNA that you're listening at home, in your office, whatever you're doing, your DNA is, the euro's, it's up 100 pips. I'm going to fade it. It's coming into really big resistance. I'm going to fade it. I don't think the euro should be up here. That's going to be your normal, that's the normal,
retail
methodology.
Crowd.
That is.
Unless you have gene editing.
It is. So when you are trading like something like crude oil that's actually breaking out in a big way and you want to fade it, fine, fade it. If you're going to fade it, take a small position, put a tight stop in. Laser, precision point your entry in.
Yeah.
Get in where you want to get in. Take a small position and don't and keep a tight stop, because if you get hit, I mean, last thing you want to do is take a small short in crude at 114. Things escalate in Russia. Then next thing you know, crude oil 48 hours later is trading at 140, and now you have a small position with a 25% loss that now has wiped out all your profits from the last 2 months just because it's a small position. And Ben says this is not an environment for mean reversion. Yeah, you're exactly right, Ben. I mean, and it's not. And that's why I wanted to make sure that you guys are, if you are trading, just remember small positions, wide stops. But if you're trading something that is actually moving like crude oil, I wouldn't even put it in a wide stop there. I would just, if you're gonna get in its way, do it small, make it quick, so it doesn't hurt too much.
But the price action tell you as well. I mean, just quickly, we've got the high of what, 116, called it 50, 116.50, called it,
something
like that, yeah.
If we
get by the way, I think we have our guest here.
Yes, Jim is here.
Oh, sorry. Yeah. Okay. So, hey, Ryan, we'll continue this conversation on the Morning Edge. So, guys, remember, if you're ForexAnalytix subscribers, I'll catch you there. Make sure you guys check out the Trader Funding Program. We've actually had 3 in 1 week. 3 people qualify for live trading accounts and are already trading live. That's pretty awesome, guys. In 1 week, or a week and a half. Pretty awesome. All right, guys.
This environment, pretty amazing. So,
Why don't you take advantage of it? All right. Anyway, thanks, guys.
All right, team. Thank you. And
Cheers,
Jim,
guys.
thank you for your patience. Appreciate you being here.
No problem.
You know, Jim,
Blake gets excited.
yeah, and you know what? I remember when we booked this interview, your comment was the world should look much different by the time we have our interview. Maybe we booked it back in November or something for this, or December. And you're definitely right. And I think that you were probably talking about what might happen in the financial markets. You didn't see a war with Russia and Ukraine coming, did you?
No, I can't say that I saw a war with Russia and Ukraine. We clearly had the Fed and what they were going to do with interest rates in the crosshairs. So now we're battling it out to see what's going to have a bigger impact on markets. Is it going to be whatever the Fed does and whether they are able to walk the tightrope, or now we've got huge geopolitical risks rattling around. So
do you want to share your screen, Jim? Was there anything, or you just want
to no, I would actually.
Okay, so it's the green button on the bottom. It says share screen. Just move your cursor over the bottom.
Let me do that. Let me go find. Here we go.
There we go.
Okay.
All right. Okay.
So now,
go. Oh, you prepared a little PowerPoint.
I got a few slides. Yeah. Let me see if I can get this full screen. Are you still seeing it?
Yeah, we can see it. It's fine.
Okay. So I know I'm the volatility guy, but this little list of things that people can put money in just really has grabbed my attention recently. This is looking at 3-month total returns across a set of kind of the usual suspects that people might want to put some money in. And I find it fascinating that over the last 3 months, only 4 of these things are in positive territory. 3 of them are absolutely tearing it up.
Yeah.
And everything else looks terrible. If you're not in metals mining, energy, and Latin America, you're talking to your clients about how they need to be patient and disciplined.
Do you think the Latin America performance is based upon that they're commodity producers rather than importers?
Sure, absolutely. I mean, in a big chunk of Latin America, when you look at what's underlying this ILF ETF is Brazil. And Brazil is commodities, is energy, and the other countries are commodity as well. So very clearly, the market has swung around and said, look, the trend is commodities.
Yeah.
Whether it's inflation, whether it's geopolitical risk, it doesn't matter. But if you don't have a way to tilt your portfolio into this space, and obviously there are other ways to play it, you are, feeling the hurt. Now, maybe, you're feeling the hurt relative to, domestic U.S. And so you can say, well, gee, we're not down as much as the S&P 500, or we're not down as much as Europe, but, you're still down. And
you know what? It depends. It depends where you're long from. Like I had a
I understand.
The last 3 years have been historic in returns and performance. So,
but
you know what? People feel like that, Jim. I've had a relatives go, "Oh, I'm losing so much money." I said, "You're not losing money. You're giving back profits."
Exactly. No, that's absolutely true. But we live in a world, particularly if you're in the advisory business, where
your high watermark.
Well, and what have you done for me lately, right?
Yeah. You're only as good as your last trade in our business.
Exactly. Anyway, this is the volatility guy talking about asset class returns. So let me move to the next one.
Okay.
So one of the ways I like to keep track of what's happening in VIX and the volatility is looking at the Cboe volatility term structure. What I like about this is these are, constant maturity measures of volatility. And, where we stand right now, two things. Very elevated. You know, I've put on here the sort of year-to-date average, as well as last year's average. I didn't go back to 2020 because obviously we know that that was a very volatile period. But, you know, we're coming off of 2021 where, you know, we had the kind of term structure that people expect, lower left to upper right, what we call contango. And I recognize that this is a different way of looking at it than the Vix Futures, which we'll get to in a second. But, you know, to have all 5 of these data points hovering up at the 30 level is highly unusual and says that, you know, nobody is sanguine about the prospects going out, you know, literally a year. And that's
that's
very
a
unusual.
Statement of confidence. Have you ever seen that before?
08.
You know,
08. We didn't have the 1-year VIX back then, you know, and 08 was, you know, generally more backward and obviously highly volatile. But certainly since 08, except for brief periods, you know, you don't see something like this. And look, I think this is clearly a statement of investor perspective related to what's happening with interest rates and the Fed and the potential knock-on effects of whatever action they take, plus this new geopolitical risk that we're facing. So people are hedged up. They are paying up for protection. And, you know, a lot of people are looking at this and saying, wow, how do I short this? Because, you know, sooner or later, we're going to get some resolution in Ukraine. Sooner or later, we're going to get some resolution around interest rates. I need to take the other side of this trade. And that may well pay off, but it's a little bit like what Blake was talking about with crude. You want to short crude right now?
Yeah, you want to short volatility right now? Yeah.
Maybe not. Anyway.
Yeah. One day event, one day could clean your house.
Exactly. Flipping it over to, you know, what a lot of people in my world are more accustomed to looking at, which is the VIX Futures. You know, again, we're seeing this term structure that is slightly backward, i.e. upper left to lower right, and frankly, very flat, very elevated, reflecting, you know, a great deal of just unease, uncertainty going out, you know, as far as we can go with the open futures contracts, and a significant change from where we started the year. You know, we started the year, albeit somewhat elevated, but, you know, we had the more or less, you know, expected contango shape to the curve, and we just don't have that right now.
Jim, can I ask you, do you follow bond volatility? Because I believe I've been reading the stress there is even higher than in the stock market.
You know, I don't have a chart available right this second, but yes, there's something called the MOVE index that tracks expectations, you know, bond volatility expectations for the bond market. And what we did see was we saw the MOVE index moving higher, even as the VIX, the equity volatility expectations, were relatively calm earlier in the year.
Yeah, nice tell maybe for us to learn about next time.
Yeah, I think you know, some people say, "Hey, come on, it's kind of disconnected. It's not a reliable tell." And in fact, the guy who invented the MOVE index, a guy named Harley Bassman, who is now with Simplify ETFs, you know, has suggested that, you know, he wouldn't read too much into it as a tell because, you know, the two markets aren't necessarily, but, you know, there's the old Wall Street view that the bond market is smarter than the stock market. And, you know, there may be something to that. I think the other thing that I watch very carefully are high yield spreads, and yields in the high yield market. And while we've seen those begin to tick higher in the last couple of months, we really haven't seen the kind of breakout that, you know, we saw in prior instances where we had, you know, a weak, a really weak equity market behind that uptick in yields. The credit markets seem to be okay right now. We'll see if that continues.
Okay.
A couple other ways that I look at my little world. Again, this is a different look at the Cboe indices. I look at the ratios. So you've got these 4 or 5 different measures, but this is a way. If you look at these, the red line is the 9-day against the 30-day, and the 9-day should be below the 30-day. If we're in a calmer market, and you saw that back in January, we had a significant little eruption, and right now these 3 lines are just kind of flat and tangled. So again, to me, that's another sign that markets really just aren't sure. You guys were talking about the possibility that we could get a rip and rally in equities, and the flip side is if something goes really wrong, either at the March Fed meeting or in the Ukraine, we could be headed down to new lows again. So the market basically 3,800. Yeah, the market is basically saying, look, I don't know what's going to happen in here, and I'm going to put all my risk right in the middle.
How are you, Jim, with doing nothing when you don't have conviction?
Oh, I do nothing far more often than most people are comfortable with. I'm very happy in markets like this to be sitting on my hands. One of my mentors drilled into me the concept of the second mouse. The first mouse. The first mouse, yeah, exactly. You don't always want to be the first mouse, right?
Yeah.
And this is a situation where, look, if you want to be the first mouse, shorting volatility, shorting crude, I don't know, whatever it is, and that might work out really, really well. And when you're the first mouse and you get it right, you can be rewarded in an outsized fashion. The flip side is, you can just have your face bashed in. And frankly, I'm not pretty enough to want my face bashed in any more than it already is.
No, that's wisdom, Jim. There is wisdom in saying, I don't know what's going to happen. A lot of people feel uncomfortable. They feel like they should always know. And I think it's wisdom to admit to yourself and to whoever you're working with or people depending on you to say, I don't know, instead of trying to entertain them with risk.
I think it's not easy to do. We fashion ourselves to have some expertise, but I totally agree with you.
How about on Twitter? No, do you ever see anyone say I was wrong?
Those tweets get deleted very quickly, don't they?
Yeah, I don't know if they get deleted. They just aren't written, is my view. So, okay, so you're neutral right now. Is there anything that we should be looking for that's going to give us, kind of like more conviction, or, are we just in a range where right now you're looking to either sell a rally, but not here, or buy a break to new lows and we're not there? And in between, like we were just talking about, you don't do anything. Are people doing strangles or any other type of option strategies with the way the VIX is situated here?
Yeah, I think, there are, and I'm not the options expert. I have some people that I can tap into for that expertise. But
what do you mainly trade, Jim, when you're when you're getting signals? What do you trade?
Yeah, so on the broader, going back to that chart of the asset class returns, I have a couple of flavors of cross-asset tactical strategies that I manage. One of which, no surprise, currently owns XME, XLE, and ILF. because it's a relatively short-term trend following strategy. There's another.
What are the three? I didn't get.
Well, they were the three that were at the top of the list that I showed. XME, XLE, and ILF. So, you know, that's a short-term trend following strategy that basically says I'm only smart enough to go where everybody else is going. And when the market changes, when the herd changes its mind, I'll change my mind too. I have a longer term strategy that is slower moving, more tax efficient, and you know, tends to own a lot of equities, broadly based. And in the volatility landscape, I use the exchange traded products, so VXX, SVXY, and I'm involved with a company that is in the process of introducing some new exchange traded products in the vol space that, you know, will represent an improvement in the mechanics of how they trade, how they rebalance, and we're hoping to have those products launch sometime soon. That's all I can say.
Okay. So Taroso, are they an RIA?
Yes.
Kind of. Okay.
Yeah, Taroso is a three-legged stool. One leg is a more or less traditional wealth management business where we work with high net worth individuals. We have several advisors who specialize in the retirement planning space, corporate retirement plans. The second leg of the stool is an investment management business where we run a wide array of separate account strategies. We also are an outsourced chief investment officer for organizations that are better at collecting money than they are at managing it. And our third leg is a business where we help people who have ideas for ETFs actually crystallize those, get them launched, get them marketed. Examples are SoFi, SoFi Stadium, where the Super Bowl was played.
Yeah.
That organization came to us when they wanted to launch a suite of ETFs targeted to their clients. We have our own ETF in the blockchain space, BLOK, which invests primarily in what I refer to as the picks and shovels of the blockchain. So we're very, very active in the ETF space, and also, as an asset manager ourselves, both for individual clients and sort of the crossover market of money managers who don't actually manage money, and some institutional accounts.
Okay, I know I've interviewed someone from your firm prior. Anyway, I have old timers. So at the moment, so Jim, we have time for maybe another slide to talk about what you're seeing, and
so let me just
confused. Yeah.
So again, using the Cboe indices, this isn't just looking at the levels of the 9-day, 30-day, 3-month, 6-month. It's when the normal setup, if you will, is 9-day below 30-day, below 3-month, below 6-month, as one would expect.
Nice.
When the markets get upset, they collect together. Sometimes the 9-day popped out a big time, at the end of January. And again, we're in this place where they're all clustered together. And, that's a flat term structure. That's basically the market saying this ain't normal. And we don't know which way it's going to go. So again, I think the market's confused. And the last thing I will do is say, one of the ways that I look at the VIX itself, just the one measure, is, and there's been research out there on this, one of the things that tends to happen is in reasonably normal markets, S&P, generally trending higher, the VIX will quiet down. And, one way to frame this is that it will get into a, what I sometimes refer to as a sideways quiet channel. It starts just trading, with small daily moves, more or less sideways. And these little red dots are what John Carter calls a squeeze. And as you can see on this, these are just two examples of a phenomenon that's not unusual. There's no guarantees, right? Mm-hmm. But if you see the VIX in a multi-day squeeze the way you did in mid-December, the way you did in early January, sometimes you might see it leave that sideways quiet channel to the upside. And so, if you're watching the VIX and you want to trade something in here, you might set up a chart that looks something like this and look for those little red dots. That is not a trade recommendation.
Okay, the little red dots are what's it called?
John Carter, who you may know, Simpler Trading. It's called he calls it the Trade the Markets, TTM.
Okay.
And the squeeze means that the Bollinger Bands, it's basically using both tightening. Bollinger Bands and Keltner channels. Yeah, they're tightening. And the Bollinger Bands have gone inside the Keltner channels. That's what the squeeze is. So it means that, things have gotten quiet, they've gotten tight, they're coiled up, and there's a chance that, you'll get a move out of that situation.
Compression
needs to be released.
Yeah. Well, I kind of vacillate between confused and agitated on your last chart for about a month. And Jim, really a pleasure to be able to speak to you and for you to take time. I know you have half an hour before the market opens, but the best way for people to keep in touch with you or get in touch with you?
Well, the easiest way is to follow me on Twitter at Vixologist.
Okay.
My DMs are open. If people want to get in touch with me, I'm happy to interact with folks on Twitter.
Cool.
Email is jcarroll, CARROLL at torossoadvisors.com.
Thank you, my trading warrior brother. Everybody, a great interview that we had with Jim Carroll at Vixologist. Thank you so much, Jim.
Thank you, Dale.
Your time. Thanks for giving, edifying the community today. All right. Thank you. All right. Adios, Jim.
Cheers.
Okay, everyone, that's a wrap for us. Remember, don't just count your red dots, count your blessings. And also, you could join the team in about 17 minutes for the morning edge. Good luck. And like Jim and Blake are saying, please, reduce leverage. And, they say that tough markets don't last, tough traders do. But don't be, as Jim said, the first mouse. I've tried it. Those traps, when they spring, they don't feel good. Thank you, Paul. Everyone's thanking you, Jim. Have a great day, everyone. See you tomorrow. Adios.